Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information shared in this video does not constitute financial, investment, legal, or tax advice. All investment strategies and decisions involve risk of loss. You should consult with a qualified professional before making any financial decisions. Your financial situation is unique, and any action you take based on the information in this video is solely at your own risk. Let's talk about a feeling. It's that quiet, nagging feeling you get when you look at your savings account statement. You've done everything you were told to do. You work hard, you put money away every paycheck, you cut back on expenses. But when you look at that number, it's just sitting there, barely growing. In fact, with inflation hitting us all like a tidal wave, you know that money is actually losing purchasing power every single day. It feels like you're running on a treadmill, putting in all the effort but going nowhere. The dream of a comfortable retirement, of owning a home without a crushing mortgage, of financial freedom. It feels like it's getting further away, not closer. What if I told you that for decades millions of Americans have been using a specific tool, a vehicle designed not just to keep up with inflation, but to systematically outrun it over the long term? A tool that doesn't require you to be a Wall Street genius, to stare at stock charts all day, or to have $1 million to get started. A tool that harnesses the power of America's most innovative and fastest growing companies and puts them to work for you. This tool is the Growth Stock Mutual Fund. Now, I know what some of you might be thinking. Mutual funds? Isn't that complicated? Isn't that risky? Isn't that something my grandpa invested in? And the answer is yes and no. The world of mutual funds is vast and frankly confusing. There are thousands of them, and many are designed to be slow, sleepy, and frankly mediocre. But hidden within that world is a specific category, growth funds, that operate on a completely different principle. Their entire mission, their sole reason for existence, is to find and invest in companies that are poised for explosive growth. We're talking about the innovators, the disruptors, the companies creating the future. The ones building the technology you'll be using in 5 years, developing the medical breakthroughs that will save lives, and changing the very way we live and work. Over the next 10 parts of this series, we are going to pull back the curtain on growth stock mutual funds. This isn't going to be a boring finance lecture filled with jargon you can't understand. This is a masterclass, a blueprint. I'm going to give you the exact knowledge you need to transform yourself from a passive saver into a confident, intelligent investor. We will solve the problem of financial stagnation. You will learn how to identify high potential funds, how to analyze what's actually inside them, how to avoid the common traps and fees that drain your returns, and how to build a portfolio that aligns with your personal goals for the future. So, what exactly is a growth stock mutual fund? Let's break it down using an analogy everyone can understand. Imagine you're the owner of a professional basketball team. Your goal is to win the championship, not just this year, but for the next decade. You have two choices for building your team. Option 1. You can sign a bunch of solid, reliable veteran players. They're not going to make any dazzling plays, they're not going to be on the highlight reels, but they'll show up, do their job, and you'll probably win about half your games. They provide stability and predictability. This is like an income or value mutual fund. It's safe, but it's not going to make you a champion. Option 2. You decide you want a dynasty, so you hire the best scouts in the world. Their job is to travel the country, watch thousands of games, and find the most talented, athletic, and driven young players with superstar potential. They're looking for the next Michael Jordan, the next LeBron James. These players are young, they might be unproven, but their potential for growth is off the charts. You then sign not just one but a whole team of these potential superstars. Some might not pan out, one might get injured, but others will explode onto the scene, becoming dominant forces in the league. Because you have a whole team of them, the success of your superstars far outweighs the ones who don't make it. Your team doesn't just win, it dominates. That is a growth stock mutual fund. The fund manager and their team of analysts are your expert scouts. They spend all day, every day, analyzing hundreds of companies. They're not looking for the old, stable, dividend-paying utility company. They're hunting for the next Amazon, the next Google, the next Nvidia, before everyone else realizes it. They're looking for companies with revolutionary products, rapidly growing sales, visionary leadership, and a huge market to conquer. And here's the most powerful part. By investing in the fund, you don't have to pick the single winner. You get to own a small piece of all of them. You get the basketball team with 50 or 100 potential superstars. This is called diversification, and it's your single greatest defense against risk. If one company fails, and some will, it doesn't sink your portfolio. The explosive growth from the winners is designed to more than make up for the losers. You get all the upside potential of high-growth stocks, with a built-in safety net. Think about the major trends that have shaped our world in the last 20 years. The rise of the internet, the smartphone revolution, the explosion of social media, e-commerce, cloud computing, and now artificial intelligence. The people who saw these trends coming and invested in the companies leading the charge have created life-changing wealth. But you didn't have to be a venture capitalist in Silicon Valley to participate. You just needed to own a growth fund that was managed by scouts who saw it coming. Their entire job is to position your money on the right side of history, to be in front of the massive technological and societal shifts that create new industries and new fortunes. This is the fundamental difference in mindset. Saving money in a bank account is playing defense. You are simply trying not to lose. Investing in a well-chosen growth stock mutual fund is playing offense. You are actively trying to win, to grow your capital significantly over time, and to build real generational wealth. But here's the catch, and this is why this series is so important. Not all growth funds are created equal. Far from it. Some are bloated, oversized ships that can't move quickly. Some are weighed down by ridiculously high fees that eat away at your profits like a parasite. Some are closet index funds, charging you high fees for basically just copying the market. And some are run by managers who simply aren't very good scouts. My promise to you in this series is to give you the playbook. We will start from the very beginning. We'll define the different types of growth, from aggressive growth to large cap growth, and help you understand which one fits your personal risk tolerance. We'll show you the key metrics to look for, like expense ratios, turnover rates, and manager tenure. I'll teach you how to read a fund's prospectus, that boring legal document, and pull out the critical information in under 5 minutes. We'll look at real-world examples of top-performing funds and break down why they succeeded. And we will expose the red flags, the warning signs that tell you to stay away from a particular fund. This knowledge is the key. It's the difference between blindly throwing your money at a fund your bank teller recommends and making a strategic, informed decision that could profoundly impact your financial future. It's about taking control. It's about moving from a position of anxiety and uncertainty about your money to a position of confidence and power. The goal isn't just to make money. It's to understand how your money is making money for you. That is true financial empowerment. So let's start right there. With that idea of understanding, let's demystify one of the most powerful and often misunderstood tools for building wealth in the United States: the growth stock mutual fund. Now, I know what some of you are thinking. The moment I say stock mutual fund, I start to glaze over. It sounds like something from a textbook, something complicated and frankly a little boring. It sounds like something for Wall Street guys in expensive suits, not for regular people trying to get ahead. But what if I told you that it's actually a beautifully simple concept? What if I told you it's less like a complex financial equation and more like organizing a massive, incredible road trip? Imagine you want to drive across the country. You've got the destination in mind, let's say a beautiful beach in California, representing your financial goals, your retirement, that dream house. But you're standing in your driveway in New York. You have a car, but it's just one car. What if it breaks down in Ohio? What if you get a flat tire in Nevada? What if you realize halfway through that your car just isn't fast enough to get you there on time? Putting all your hopes, all your money, into that one car feels incredibly risky. This is what it feels like for most people when they think about buying individual stocks. You hear about a hot tech company or a revolutionary biotech firm. Sounds amazing. But buying its stock is like betting your entire cross-country trip on that one single car. If that company succeeds, you're golden. But if it fails, you're stranded on the side of the road. The anxiety is overwhelming. Now, what if instead you and 100 of your friends all decided you wanted to go on the same road trip? You all pool your money together. Suddenly, you don't have enough for just one car. You have enough for a whole fleet of them. You can buy a dozen different cars, all shapes and sizes. You've got reliable sedans, sturdy SUVs, even a few high-performance sports cars. If one car gets a flat tire, it's no big deal. The other 11 are still on the road, making progress. You've spread out your risk. That, in its essence, is a mutual fund. It's a giant pool of money, collected from thousands of investors just like you, all heading toward a similar destination. And the best part? You don't have to drive. The fund has a professional driver, a fund manager and their team of analysts, whose entire job all day, every day, is to map the best route, maintain the cars, and decide which ones to drive to get the whole group to the destination safely and efficiently. You're not just buying a single stock. You're buying a tiny piece of a massive, professionally managed portfolio of stocks. You get instant diversification. You get a professional at the wheel. That's the mutual fund part. It's a collective journey. But now for the most important question. What kind of road trip is this? Are we taking the slow, scenic route? Or are we hitting the express lane? This is where the growth stock part comes in. Let's go back to our fleet of cars. We could have filled our fleet with big, reliable, dividend-paying minivans. They're safe, they're comfortable, they move at a steady pace. They're not going to break any land speed records, but they'll get you there. In the investing world, these are often called value stocks. Think of large, established companies that pay out a portion of their profits to shareholders. But a growth stock mutual fund? That's different. We are not buying a fleet of minivans. We are buying a fleet of rocket ships. A growth company is one that is laser-focused on one thing: expansion. Rapid, explosive expansion. These are the innovators, the disruptors, the companies trying to change the world. Think of a young tech company that just invented a revolutionary piece of software, or a biotech firm on the verge of a medical breakthrough. These companies typically don't pay dividends to their shareholders. Why? Because they're taking every single dollar of profit and plowing it right back into the business. They're hiring more brilliant engineers, building bigger factories, expanding into new markets, and funding groundbreaking research and development. They are sacrificing today's small payouts for the potential of massive future growth. They are not trying to cruise. They are trying to achieve liftoff. So, a growth stock is a share in one of these rocket ship companies. The hope is that as the company grows and becomes more successful, the value of your share will skyrocket along with it. The risk, of course, is that rocket ships are volatile. Some might fizzle out on the launch pad. Some might explode mid-air. They are inherently riskier than the steady, reliable minivan. And this is where the profound power of the growth stock mutual fund comes into play. Solves this exact problem. You're not just betting on one rocket ship. You're buying a small piece of a whole launch pad full of them. The fund manager is your mission control. Their team analyzes the engineering, the fuel, the trajectory of hundreds of potential rockets. They then select a diversified fleet of what they believe are the most promising ones. Maybe they pick a few large, powerful rockets that are already proven spacefares. Think established tech giants that are still innovating. Then they add some medium-sized rockets with exciting new technology. And they'll likely sprinkle in a few smaller, experimental rockets that have the potential to be the next big thing, but also carry the highest risk. If one of the experimental rockets fails, it's disappointing, but it doesn't doom the mission. The success of the other rockets in the fleet can more than make up for the duds. You get to participate in the thrilling, high-potential world of growth investing, but with a built-in safety net of diversification. You're harnessing the power of explosive growth while managing the inherent risk that comes with it. This isn't about gambling. It's about calculated, strategic positioning for the future. It's for people who have a longer time horizon, say 10, 20, or 30 years until they need the money. It's for a retirement account or a college fund for a young child. That long runway gives the rocket ships time to reach their cruising altitude. It allows you to ride out the inevitable turbulence, the market ups and downs, because you're focused on the destination, not the bumpy air you might hit along the way. So when you invest in a growth stock mutual fund, you're not just buying a ticker symbol. You are becoming a silent partner in innovation. You are owning a piece of the companies that are actively building tomorrow's world. Your money is funding the next generation of technology, the future of healthcare, the evolution of how we live, work, and play. You're moving from a passive saver, where your money sits in an account, slowly being eroded by inflation, to an active owner. You are providing the capital that fuels the American engine of growth, and in return you get to share in the rewards of that growth. It's a fundamental shift in mindset. And that brings us to the most critical part of this entire discussion. We understand the what? A diversified portfolio of high-growth companies. We understand the why, to achieve potentially higher long-term returns. But what about the how? How do you actually choose one? They have names that sound like a secret code, letters and symbols that mean nothing to the average person. They come with different fees, different strategies, and different managers. How do you look under the hood of these funds to see what you're really buying? How do you read the map so you know you're on the right road trip for you? Because picking the wrong one can be just as costly as picking the wrong individual stock. Cracking that code is the key to unlocking their true power. So let's start cracking that code. The first thing you need to understand is that every mutual fund comes with its own instruction manual, its own secret playbook. Most people never read it. They see a thick, boring-looking legal document and their eyes glaze over. But this document, called a prospectus, isn't a legal trap. It's a treasure map. And if you know which 2 or 3 pages to look at, you can learn everything you need to know in about 10 minutes. This is the single biggest cheat code to investing in mutual funds, and almost no one uses it. Forget the pages of legal jargon. We're going on a hunt for the fund's DNA. The first thing you look for is a section usually called Investment Objective, or Principal Investment Strategies. This is the fund telling you in its own words what it's trying to do. It's the mission statement. Is it trying to hit a home run every time it steps up to the plate? Or is it just trying to get on base consistently? Is it investing in giant established companies or tiny explosive startups? This section is the fund's promise to you. For a growth fund, you'll see words like capital appreciation, which is just a fancy way of saying grow your money as much as possible. But dig deeper. Does it say large capitalization companies? That means they're fishing in the pond of giants. The Apples, the Microsofts, the Amazons of the world. These are the established titans. Or does it say small or mid-capitalization? Now we're talking about a completely different game. These are the companies that want to become the next Apple. They're riskier, more volatile, but their potential for explosive growth is exponentially higher. Right there, in that one paragraph, you've just learned whether you're investing in a stable battleship or a fleet of nimble speedboats. Once you know the mission, the next step is to see if they're actually doing what they promise. You're going to look for the top 10 holdings. This is the most important gut check you can do. This list shows you the 10 biggest companies the fund is invested in. It's a snapshot of the fund's heart and soul. You are literally looking at the all-star players on the team. Do you recognize the names? If you're looking at a US large-cap growth fund, you should probably see some familiar faces from the tech and consumer worlds. If you don't, that's a red flag. Not because they're bad companies, but because it might not align with the fund's stated goal. Think of it this way. If you bought a fund that promised to invest in the future of American technology, and its top holding was a 150-year-old railroad company, you'd know something was wrong. The top 10 holdings tell you the story. You can see the fund's biases, its big bets. Is it heavily concentrated in one sector like technology? That tells you the fund manager is making a huge bet that tech will outperform everything else. That's more aggressive. Or are the top holdings spread out across healthcare, tech, and retail? That's a bit more diversified, a little less risky. This isn't about judging their picks as good or bad. It's about understanding the flavor of the fund. Does this collection of companies get you excited about the future? If you look at the list and think, wow, I believe these 10 companies are going to change the world, then you're on the right track. If you look at it and feel confused or skeptical, it might not be the fund for you no matter how good its returns look. Now this brings us to the most overlooked character in this entire story. The fund manager. Who is the person or the team actually making these decisions? You bought the fund, but they're the ones driving the car. You need to know if you've got a seasoned pro behind the wheel or a teenager with the learner's permit. In the prospectus or on the fund's summary page, look for the manager's name and, crucially, their tenure. Tenure just means how long they've been managing this specific fund. Why is this so critical? Because funds build up these legendary reputations over decades. You might buy a fund called the Galaxy Quest Growth Fund, because it has an amazing 20-year track record. But if you look closer, you might see that the genius manager who generated those returns for 19 years just retired last month. The person in charge now has only been on the job for 6 weeks. So, are you investing in that incredible 20-year track record? No. You're investing in a brand new 6-week track record. You're the guinea pig. Conversely, if you see a manager has been at the helm for 12, 15, even 20 years, that's incredibly valuable information. It means they've navigated through market crashes, through bubbles, through recessions. Their performance numbers aren't a fluke. They're a reflection of a consistent philosophy. They've been tested by fire. Finding a great fund with a long-tenured, successful manager is like finding a championship-winning coach who is still in their prime. It dramatically increases your odds of success. Okay, you know the mission, you've seen the top players, and you know who the coach is. Now we have to talk about the cost of your ticket to the game. This is, without a doubt, one of the most important numbers you will ever look at, the expense ratio. The expense ratio is the fee the fund company charges you every single year to manage your money. It's expressed as a percentage, and it's automatically deducted from your investment returns. You never get a bill for it. It just gets skimmed off the top silently day after day. And it can be the single biggest drag on your long-term growth. Let's say you're looking at two different growth funds. Fund A has an expense ratio of 1.2%. Fund B has an expense ratio of 0.4%. You might think, what's the big deal? It's less than 1% difference. That thinking will cost you a fortune. Let's run the numbers. If you invest $10,000 in both funds and they both earn an average of 10% per year for 30 years, your investment in Fund B, the one with the lower fee, would be worth over $66,000 more than your investment in Fund A. $66,000. Gone. Vanished into thin air, eaten up by that seemingly tiny 1% difference in fees. It's the equivalent of having a small hole in your bucket. At first, you barely notice the drip. But over time, you realize you've lost half your water. When you're looking at growth funds, you want the lowest expense ratio you can find for a fund that meets your criteria. Active management costs more than passive indexing, that's a given. But a high fee is a permanent, guaranteed headwind you have to overcome every single year just to break even with the cheaper competitor. Finally, after you've checked all of those boxes, now you can look at the past performance. Most people look at this first, but it's actually the least reliable predictor of the future. The financial industry is legally required to tell you that past performance is no guarantee of future results, and they are 100% right. But that doesn't mean it's useless. You just have to look at it the right way. Don't be seduced by a flashy one-year return. Any fund can have one lucky year. That's noise. You want to look at the 3-year, 5-year, and especially the 10-year average annual returns. This smooths out the lucky streaks and the bad years, giving you a much better picture of long-term consistency. And here's the pro move. Compare that performance not just to other funds, but to its benchmark index. A large-cap growth fund should be compared to an index like the S&P 500 Growth Index or the Russell 1000 Growth. Is the fund consistently beating its benchmark over those long-term periods, even after accounting for its expense ratio? If it is, that tells you the manager is earning their keep. They're adding real value. And look at how the fund performed during bad times. Pull up a chart and see what happened to it in the 2008 financial crisis or the flash crash in early 2020. Did it fall off a cliff, dropping way more than the overall market? Or did it hold up relatively well? This shows you its defensive capabilities. A fund that captures most of the market's upside, but protects you from some of the downside, is a true gem. It tells you the driver isn't just a speed demon on a straightaway. They know how to handle the car when the road gets icy. By looking at these key elements, the objective, the holdings, the manager, the cost, and the long-term performance, you've moved from being a passive passenger to an informed co-pilot. You're no longer just throwing a dart at a board and hoping it sticks. You're making an educated decision based on the fund's actual DNA. You now understand that two funds with the label US Growth Fund can be as different as a Ferrari and a Ford F-150. One is built for pure, unadulterated speed, and it's thrilling, but it can spin out on the slightest curve. The other is a powerful, durable workhorse, designed to haul a heavy load for the long haul. Neither is inherently better, but one is definitely better for you and your specific journey. And knowing how to tell them apart is everything. Now the question becomes, how do you combine these different vehicles to build a truly powerful convoy? How do you blend the speed of small caps with the stability of large caps? That's where portfolio construction comes in, and it's where the real magic begins. And this magic isn't some secret Wall Street incantation. It's a disciplined strategy, a blueprint that investors have used for decades to balance the hunt for explosive returns with the need for stability. Think of it less like magic and more like architecture. You wouldn't build a skyscraper by just randomly stacking beams and glass. You need a solid foundation, a strong core, and then you can get creative with the design on top. Your investment portfolio is no different. The most powerful and common-sense way to structure a portfolio of growth mutual funds is using a strategy called core and satellite. It's elegant in its simplicity, but incredibly effective in practice. Imagine your entire investment portfolio is a solar system. At the very center, holding everything together with its immense gravitational pull, is your core. This is the sun. It's big, it's reliable, and it's the dominant force in your financial universe. Surrounding this core are your satellites, the planets. They are smaller, more nimble, and they each have their own unique characteristics. Some might be hot and volatile. Others might be in a steady, predictable orbit. Together, they create a balanced, functioning system. So let's break down the roles. Your core holding is the foundation of your growth strategy. This is typically going to be a large-cap growth mutual fund. Why? Because as we discussed, these funds invest in the biggest, most established and financially sound companies in America. The Apples, the Microsofts, the Amazons of the world. These companies aren't likely to go bankrupt tomorrow. They have massive cash reserves, dominant market positions, and global reach. A large-cap growth fund provides you with diversification across dozens, if not hundreds, of these blue-chip giants. It's your anchor in the storm. When the market gets choppy, these are the companies that tend to hold up the best. This core position is designed for steady, long-term appreciation. It's not meant to be the most exciting part of your portfolio, but it is, without a doubt, the most important. It's the engine of your convoy, the part that keeps you moving forward year after year. Now for the exciting part, the satellites. These are the positions you add to your portfolio to supercharge your returns. They orbit your stable core and are designed to capture more specific, high-growth opportunities. This is where your small-cap and mid-cap growth funds come into play. A small-cap growth fund is your aggressive satellite. It's your Mars rover, sent to explore new, potentially rewarding frontiers. It's investing in the innovators, the disruptors, the companies that could be the next household name, or could fizzle out. Because of this higher risk, you allocate a smaller portion of your portfolio here. It has the potential to deliver incredible returns that can significantly boost your overall performance, but you don't bet the whole farm on it. Then you have your mid-cap growth fund. This is another key satellite, perhaps the Jupiter of your system, not as big as the sun but still a powerful force. Mid-cap funds, as we know, are the sweet spot. They offer a compelling blend of the growth potential of small companies and the relative stability of larger ones. They've already proven their business model, but still have significant room to grow. Adding a mid-cap fund as a satellite gives your portfolio a powerful second engine, providing a different source of growth that often moves independently of the large-cap giants. You can even have more specialized satellites like a sector-specific fund. For example, if you're particularly bullish on the future of artificial intelligence or biotechnology, you could add a technology or healthcare fund as a small targeted satellite. This is a more advanced move as it concentrates your risk in one industry, but it illustrates how flexible the core and satellite strategy can be. Okay, so we have the theory. A large cap core for stability, with small cap and mid cap satellites for a performance boost. The billion-dollar question is, how do you actually allocate your money? What percentage goes where? This is where it becomes personal, and it depends heavily on your age, your time horizon, and your tolerance for risk. There's no single right answer, but we can look at a few common models to give you a concrete framework. Let's start with a conservative growth model. This might be for someone who is a bit closer to retirement or simply has a lower tolerance for big market swings. Here, the emphasis is on capital preservation with a healthy dose of growth. A typical allocation might be 70% in your core large-cap growth fund, 20% in your mid-cap growth fund, and 10% in your small-cap growth fund. See the logic? The vast majority of the capital is in the stable anchor, the large caps. The satellite positions are smaller, providing a little extra kick without introducing a massive amount of volatility. It's a sturdy, reliable structure. Next, let's look at a balanced growth model. This is a popular middle-of-the-road approach, great for someone with a couple of decades until retirement. It seeks a more even blend of stability and aggressive growth. The allocation might look like this: 60% in the core large cap fund, 20% in the mid cap fund, and 20% in the small cap fund. Here you're dialing down the core just a little to give more fuel to your higher octane small cap satellite. You're taking on a bit more risk in exchange for potentially higher long-term returns. It's a confident, forward-looking stance. Finally, let's consider an aggressive growth model. This is often suited for a younger investor, someone in their 20s or 30s with a very long time horizon. They have decades to recover from any market downturns and can afford to take on more risk for the chance at maximizing growth. This allocation could be 50% in the core large cap fund, 25% in the mid cap fund, and 25% in the small cap fund. Notice the core is now only half the portfolio. The satellites have a much larger role, with equal significant weight given to both the mid-cap and small-cap engines. This portfolio is built for speed. It will experience more ups and downs, more volatility, but over a 30 or 40-year period, it has the mathematical potential to generate the highest returns. These percentages are not commandments written in stone. They are starting points, templates for you to think about. You could adjust them by 5 or 10% in any direction to fit your personal comfort level. The key principle is that the core always remains the largest single position. It's the bedrock. You build around it, you don't replace it. The beauty of this strategy is how it manages risk through diversification, not just across different companies, but across different sizes of companies. In some years, technology giants might lead the market, and your large-cap core will shine. In other years, a booming economy might favor smaller, nimble companies, and your small-cap satellite will be the star performer. By owning all of them, you ensure that no matter which segment of the market is having its moment, you're participating. You're smoothing out your returns and creating a more resilient, all-weather growth machine. It's a team effort. You don't build a championship basketball team with 5 identical players. You need a mix of skills, sizes, and specialties. Your portfolio is your financial championship team. So now you have the blueprint. You understand the architectural plan of the core and satellite strategy. You have the models for how to allocate your capital based on your personal goals. The structure is designed, but a blueprint is useless without the right materials. How do you choose the specific funds to fill these roles? Out of the hundreds of large-cap growth funds available, which one is the right one to be your core? What metrics, what data points should you be looking at to separate a world-class fund from a mediocre one? That's the next critical piece of the puzzle. We've designed the convoy. Now we have to pick the vehicles. We need to look under the hood. This means diving into things like expense ratios, manager tenure, portfolio turnover, and learning how to read a fund's prospectus. It's time to move from strategy to selection. So let's start with the single most important number you will ever see attached to a mutual fund. It's the first thing you should look for, the gatekeeper that decides whether a fund is even worthy of your further consideration. I'm talking about the expense ratio. Think of the expense ratio as the fund's price tag. It's the annual fee, expressed as a percentage of your investment, that you pay to the fund company for the privilege of them managing your money. It covers everything from the manager's salary to marketing costs, to administrative paperwork. And it is, without a doubt, the silent killer of long-term returns. It seems so small, right? You see a fund with an expense ratio of 1.2% and another with 0.2%. The difference is just 1%. What's 1%? In the world of compounding, 1% is a universe. That tiny number is a constant drag on your performance, like trying to run a marathon with a small weight strapped to your ankle. For the first mile, you barely notice it. But by mile 26, it's the only thing you can think about. Let me make this painfully clear with an example. Let's say you invest $10,000 into 2 different growth funds. Both funds earn a respectable 8% average annual return before fees. Fund A has a typical expense ratio of 1.2%. Fund B is a lean, low-cost option with an expense ratio of 0.2%. After you subtract the fees, Fund A is actually giving you a 6.8% return, while Fund B is giving you 7.8%. One single percentage point. Let's check in after 10 years. Your $10,000 in the high-cost Fund A has grown to about $19,300. Not bad. But in the low-cost Fund B, it's over $21,000. That's an $1,800 difference just from that one tiny percent. The fee has already cost you a fancy dinner for 10. Now let's fast forward 30 years. The magic of compounding has been at work, but so has the tyranny of high fees. Your initial $10,000 in the high-cost Fund A has grown to a very respectable $72,000. You've done well. But what about Fund B, the low-cost champion? Your $10,000 has ballooned to nearly $95,000. Let that sink in. The difference is $23,000. That single, innocent-looking 1% fee has silently siphoned off more than double your entire initial investment. It's the cost of a new car. It's a down payment on a house. It is the single greatest predictor of future fund performance. Lower costs mean more of the market's return ends up in your pocket, not the fund companies. So, rule number 1, hunt for low expense ratios like your financial future depends on it, because it does. Okay, so we've checked the price tag. Now, who's driving this thing? This brings us to our second checkpoint, manager tenure. This tells you how long the current fund manager or management team has been at the helm. Why does this matter? Because a fund's track record is not attached to the fund's name. It's attached to the people who made the decisions. Imagine you're looking at a fund with a spectacular 15-year performance history. It's beaten the market, it's a 5-star fund, everyone's talking about it. But then you look at the manager tenure, and you see the star manager who achieved those returns just retired 2 months ago. The person in charge now is a rookie. Are you buying into a proven track record? Or are you the guinea pig for a new and proven strategy? A long manager tenure, say 10 years or more, suggests stability. It tells you that the person who built that track record is likely the same person who will be managing your money tomorrow. It implies a consistent philosophy, a process that has been tested through different market cycles, through bull markets and bear markets. High manager turnover, on the other hand, can be a red flag. It might suggest internal turmoil at the fund company or a lack of a coherent, long-term vision. You want a captain who has weathered a few storms, not one who just got their license. Next, we need to look at how the manager drives. Are they a calm, long-distance cruiser? Or are they a frantic day trader, constantly weaving in and out of traffic? This is measured by something called portfolio turnover. Turnover is a percentage that tells you how much of the fund's portfolio has been replaced over the past year. A turnover rate of 100% means that, on average, the manager sold and replaced every single stock in the portfolio within that year. A rate of 20% means only 1/5 of the holdings were changed. Now, a high turnover isn't automatically bad, and a low one isn't automatically good. But it tells you a lot about the fund's strategy, and more importantly, its hidden costs. A fund with high turnover, say over 100%, is being managed very actively. The manager is making a lot of trades, trying to time the market, and jumping on short-term opportunities. This can sometimes lead to big gains. But every single time the manager buys or sells a stock, it generates trading costs, brokerage commissions, bid-ask spreads. And guess who pays for those costs? You do. These costs are not included in the expense ratio. They are an additional, invisible drag on your returns. High turnover can also trigger more frequent capital gains distributions, which can lead to a higher tax bill for you if you're investing in a regular taxable brokerage account. A fund with low turnover, say under 30%, suggests a completely different philosophy. It's a buy and hold approach. The manager is making high conviction, long-term bets on companies they believe in for the next 5, 10, or even 20 years. This approach leads to lower internal trading costs and is generally more tax efficient. It shows a manager who is patient and confident in their research. The key is to check if the turnover rate matches the fund's stated strategy. If a fund claims to be a long-term investor in quality companies, but has a 150% turnover rate, something is wrong. The story doesn't match the actions. So we've checked the price, we've met the driver, and we understand their driving style. Now it's time to read the owner's manual. This is the fund's prospectus. I know. The word prospectus sounds terrifying. It conjures up images of a 100-page legal document written in a language only a lawyer could love. And you're not wrong. But here's the secret. You don't have to read the whole thing. You just need to know where to find the gold. Most funds now offer a summary prospectus, which is usually just a few pages long and gives you the vital information in plain English. This is your cheat sheet. When you open it, you're going to scan for 4 key sections. First, the investment objective and strategy. This is the fund telling you in its own words what it's trying to do. Does it say it invests in large-cap U.S. growth stocks? Does its description of the types of companies it looks for, like those with innovative products or high earnings growth, align with your goals? This is a simple gut check to make sure you're in the right place. Second, scroll down to the principal risk section. Don't skip this. Every investment has risk, and this is where the fund company is legally required to tell you what could go wrong. Are they warning you about the risk of concentrating in a single sector like technology? Are they concerned about the volatility of smaller growth companies? Reading this helps you understand the potential downside and ensures you're comfortable with the specific risks you're taking on. Third, find the fees and expenses table. This is where you'll confirm that beautiful low expense ratio we talked about. But you'll also look for other pesky fees. Is there a purchase fee or a redemption fee for getting in or out? Most good funds don't have these. Is there a 12b1 fee? This is a hidden marketing fee that you should avoid at all costs. The table lays it all out in black and white. Finally, look for the performance chart and table. This shows you the fund's year-by-year returns, often compared to a benchmark index, like the Russell 1000 Growth Index. How did the fund do during a great year for the market like 2021? More importantly, how did it do during a terrible year like 2022? Did it lose more or less than its benchmark? You're looking for a pattern of consistent, long-term outperformance, not just one lucky year. These 4 checkpoints, expense ratio, manager tenure, portfolio turnover, and a quick scan of the prospectus, form the quantitative foundation of your analysis. They are the numbers, the hard facts that allow you to quickly sift the good from the bad and the overpriced. This is how you move from a universe of thousands of funds to a manageable shortlist of worthy contenders. But numbers only tell half the story. A low-cost fund with a great manager might still be filled with companies you don't believe in. To truly understand what you're buying, we have to go one level deeper. We need to pop the hood and analyze the actual stocks the fund holds, its top 10 holdings, its sector weightings, and the overall quality of the portfolio. That's where we go from being a fund buyer to a true fund analyst. And this is, without a doubt, the single most important step in the entire process. Looking at past performance is like looking in the rearview mirror. Analyzing the manager is like betting on the jockey. But analyzing the holdings, that's looking at the horse itself. This is where you separate yourself from 99% of mutual fund investors who just look at a star rating and throw their money in, hoping for the best. So where do we start? The top 10 holdings. This is your first, most critical checkpoint. For most growth funds, the top 10 positions can make up anywhere from 20% to over 60% of the entire portfolio. This is the 80-20 rule in action. These few stocks will have an outsized impact on the fund's performance. You can find this list for free on the fund's official website or on financial portals like Morningstar or Yahoo Finance. It's public information. The first thing you're looking for is concentration. Is 60% of the fund packed into just 10 companies? That tells you the manager has extremely high conviction. They aren't just diversifying for the sake of it. They are making concentrated bets on their absolute best ideas. The upside? If those bets are right, the fund can produce spectacular returns. The downside? If one or two of those big bets go wrong, it can drag the entire fund down. There's less of a safety net. A fund with only 20% in its top 10 is by definition more diversified. It's less reliant on any single stock. It will likely be a smoother ride, but it might not capture the same explosive upside. There's no right or wrong answer here. But you need to know what kind of vehicle you're getting into. Are you signing up for a Formula One race car or a reliable family sedan? The top 10 concentration tells you. Next, you perform what I call the sniff test. Look at the names. Do you recognize them? Are they the titans of industry, the Microsofts, the Amazons, the Nvidias? Or are they companies you've never heard of? Are they profitable, established leaders? Or are they speculative story stocks that haven't earned a dime yet? Again, neither is inherently bad, but they represent wildly different strategies. If you see a list of household names, you're likely looking at a quality growth strategy. If you see a list of obscure biotech or software companies, you're looking at a much more aggressive, venture capital style of public market investing. You have to ask yourself, am I comfortable owning these specific businesses? Because when you buy the fund, you are. You're a part owner of every single one. But here's the most powerful reason to check the top 10 holdings. Avoiding unintentional concentration in your own portfolio. This is a massive mistake that millions of investors make. They think they're diversified because they own 3 different large-cap growth funds. But when they pop the hood, they discover that the top 5 holdings in all 3 funds are exactly the same. They all own Apple, Microsoft, Nvidia, Amazon, and Meta. So they haven't achieved diversification at all. They've just bought the same bet 3 different times, likely paying 3 sets of fees for the privilege. By checking the holdings, you can ensure that if you own multiple funds, they are genuinely different and are diversifying your risk, not secretly amplifying it. Once you've dissected the top 10, it's time to zoom out to the 30,000-foot view. Sector weightings. If the top 10 holdings are the star players on the team, the sector weightings tell you the team's overall strategy. Is this an all-out offensive team? Or is it built on defense? Every fund summary will have a chart showing you its allocation to sectors like information technology, healthcare, consumer discretionary, industrials, and so on. This is the fund manager's blueprint. It reveals their macroeconomic view of the world. If a fund has 45% of its assets in information technology, the manager is making a huge, explicit bet on the future of tech. They believe that's where the growth is. If another fund has its largest weightings in healthcare and industrials, that manager sees growth in different areas, perhaps an aging population and a manufacturing renaissance. This lets you align a fund with your own beliefs about the economy. If you believe artificial intelligence is the most powerful force for the next decade, you'd want a fund heavily weighted in technology. But you also need to understand the risk. That same tech-heavy fund that soars in a low-interest rate environment can get absolutely hammered when rates go up and investors get fearful. A fund with more balanced sector exposure might not have the same dizzying highs, but it will likely offer more stability in turbulent markets. Understanding sector weights prevents you from accidentally buying a fund that is positioned for an economic environment you completely disagree with. It's like checking the weather before you get dressed. You don't want to wear shorts and a t-shirt if the fund's strategy is built for a blizzard. Now we go one level deeper. We've looked at the individual stocks and the sector strategy. Now we have to assess the overall character of the portfolio. This is where we look at portfolio-level metrics and a sneaky little problem called style drift. Most fund data pages will show you summary statistics for the entire portfolio, like the average price to earnings, or PE ratio. You don't need to be a Wall Street analyst to use this. A high PE ratio, say over 35, generally means the fund is full of companies where investors are paying a high price for expected future growth. It's an aggressive, growth at any price portfolio. A lower PE ratio, maybe in the 20s, suggests a growth at a reasonable price or GARP strategy. The manager is still looking for growth, but they're more disciplined about how much they're willing to pay for it. This one number gives you a powerful snapshot of the fund's risk appetite. Then there's the critical issue of style drift. This is when a fund manager starts to deviate from their stated mission. The fund might be called the US Large Cap Growth Fund, but when you look under the hood, you find it's holding a bunch of smaller mid-cap stocks, or maybe even a significant chunk of international companies. Why does this happen? Sometimes a manager in a competitive space, like large cap growth, feels they can't get an edge competing against everyone else for the same 50 stocks. So they drift into other asset classes like mid-caps to try and juice their returns. The danger here is that you, the investor, are no longer getting what you paid for. You bought a large cap fund to give you exposure to stable, blue-chip American companies, but you've unknowingly been sold a portfolio with higher risk and a different geographic footprint. It messes up your entire asset allocation. This is a major red flag. A manager who is drifting from their style is either undisciplined or is telling you they can't win by playing by the rules they set for themselves. Let's put this all together with a quick case study. Imagine two funds, Fund A and Fund B. Both are called US Growth Fund, and both have a 5-star rating from Morningstar. On the surface, they look identical. You pop the hood on Fund A. You see its top 10 holdings make up 55% of the portfolio. The top 5 are all mega-cap tech stocks. The sector breakdown shows a 50% weighting to information technology. The portfolio's average PE ratio is a sky-high 42. Then you look at Fund B. Its top 10 holdings are only 25% of the portfolio. You see a mix of tech companies, but also a major healthcare company, a payment processor, and a leading industrial firm. The sector breakdown is much more balanced. 28% in tech, 22% in healthcare, 18% in consumer discretionary. The portfolio PE ratio is a more modest 28. Are either of these funds bad? No, but they are completely different investments for completely different people. Fund A is a highly concentrated, aggressive bet on a specific vision of the future, dominated by big tech. It will be incredibly volatile. Fund B is a diversified, quality growth portfolio that is built to perform well across a wider range of economic conditions. Before you did this analysis, you would have had no idea. You would have been flying blind. By looking at the holdings, the sectors, and the style, you move from being a passenger to being the pilot. You understand the engine, you understand the flight plan, and you know exactly where the investment is designed to take you. Now that we know exactly what we're buying, we have to tackle the other side of the equation. What is it costing us? Because even the greatest portfolio in the world can be crippled by the silent, wealth-destroying power of fees. And that brings us to the most important number on any fund's fact sheet: the expense ratio. The expense ratio is the single most reliable predictor of a mutual fund's future performance. Let me say that again because it flies in the face of everything you see in glossy financial ads. It's not the star manager, it's not the 5-star rating, it's not the mind-bending past returns. It's the price tag. The expense ratio is a tiny percentage, usually something like 0.5% or 1.2%, that represents the annual cost of owning that fund. It's automatically deducted from your investment every single year, whether the fund makes money or loses money. It's a silent, relentless, guaranteed headwind blowing against your portfolio. Think of your investment as a giant ship on a long voyage to the island of retirement. The market's return is the wind in your sails. Some years the wind is strong, pushing you forward. Other years it's calm or even blows against you. You can't control the wind. But the expense ratio? That's a small, deliberate hole drilled in the bottom of your ship. Doesn't look like much at first. Just a tiny insignificant leak. But every single day, a little bit of your wealth is leaking out into the ocean. Over a 30 or 40-year voyage, that tiny leak can sink the whole ship, or at the very least, leave you stranded far from your destination. This isn't just a metaphor. Let's make it real. Let's tell the story of two investors, Alex and Ben. They're neighbors, both smart, both diligent savers. On the same day, they each invest $10,000 into a U.S. growth stock mutual fund. They plan to leave it there for 30 years. Both of their chosen funds manage to achieve the exact same average gross return before fees. A solid 8% per year. The only difference, the single variable in this entire experiment, is the fee. Alex, having done his homework, chooses a low-cost fund. It's not flashy, but it's efficient. Its expense ratio is a tiny 0.1%, a tenth of a penny on the dollar. Ben, on the other hand, is captivated by a fund with a charismatic manager and a slick marketing brochure. He doesn't pay much attention to the fees. His fund's expense ratio is 1.1%, just 1% higher than Alex's. One single penny on the dollar. In the grand scheme of things, what's 1%? Sounds like nothing. A rounding error. Let's check in after 1 year. The market was good. Both funds earned 8%. Alex's $10,000 after his 0.1% fee grew to $10,790. Ben's $10,000 after his 1.1% fee grew to $10,690. A difference of $100. Ben shrugs. It's the price of admission for a top-tier manager, he thinks. No big deal. Now let's fast forward 10 years. Compounding has started to work its magic. Alex's account, growing at a net 7.9%, is now worth $21,390. Ben's account, growing at its slower 6.9%, has reached $19,495. The gap has widened to nearly $2,000. Ben is starting to feel a little uneasy. That's a nice vacation he missed out on. But the truly devastating power of fees is only revealed over a lifetime. Let's jump forward to the 30-year mark. Alex opens his statement. His initial $10,000 has compounded into a staggering $98,395. He's almost a tenfold millionaire on that single investment. He's thrilled. He's ready to retire. Then he walks over to Ben's house. Ben opens his statement with a sense of dread. His initial $10,000 in a fund that had the exact same raw investment performance is now worth just $74,693. The gap between them is now $23,702. That 1% fee didn't just cost Ben 1%. Over 30 years, it vaporized more than double his entire initial investment. It's a down payment on a house. It's a child's college education. It's years of retirement security. Gone. Leaked out through that tiny, insignificant hole in the bottom of his ship. Ben paid a fortune, and for what? For the privilege of underperforming. Now, the most common argument you will hear from the financial industry is, you get what you pay for. Higher fees pay for better talent, more research, and ultimately better returns. That sounds logical. It's how the world works for cars, for houses, for watches. But for mutual funds, it is a dangerous and statistically proven lie. Study after study, most famously the Spiver reports, which track this very thing, show that over any meaningful long-term period, 10, 15, 20 years, the vast majority of high-cost, actively managed funds fail to beat their low-cost passive index benchmark. Think about what that means. The fund manager charging you 1% has to not only match the market's return, but they have to beat it by at least 1% just for you to break even with the cheap fund. They are starting the race a full lap behind, and they have to do it year after year after year. Some can, for a little while, but the data is overwhelming. Very few can do it consistently. So when you pay a high expense ratio, you are not paying for a higher probability of success. You are, in fact, paying a premium for a statistically higher probability of failure. It's like paying more for a sports car that has a slower engine. It makes no sense. And the expense ratio, as terrifying as it is often just the beginning. It's the main villain, but it has a whole crew of henchmen. First, you have sales loads. This is a fancy term for a commission. A front-end load is a fee you pay right off the top. You want to invest $10,000? A 5% front-end load means $500 vanishes before your money even gets to work. It's gone. A back-end load is the opposite. They sting you on the way out, taking a percentage when you sell. The simple solution here is to almost exclusively consider no-load funds. There is absolutely no reason in the modern era to pay a commission just for the privilege of giving a company your money. Then you have the truly absurd ones like 12b1 fees. These are often baked into the expense ratio, but they're worth calling out. A 12b1 fee is money the fund takes from your investment to pay for its own marketing and advertising. Let that sink in. You are paying them to create commercials and brochures to convince other people to invest. It's like paying a restaurant for the billboard they put up on the highway. It's outrageous, and it's a hallmark of a fund that does not put its investors first. Finally, there's a hidden cost you won't see on the sticker price: portfolio turnover. A fund's turnover ratio tells you how often the manager is buying and selling stocks within the portfolio. A turnover of 100% means they've essentially replaced the entire portfolio within a year. Why does this matter? Because every time they buy or sell, they incur trading costs like brokerage commissions. These costs aren't included in the expense ratio, but they still eat away at your returns. It's called frictional cost. High turnover can also be tax inefficient, generating more short-term capital gains that get passed on to you. A fund with high turnover is like a nervous driver constantly slamming on the gas and then the brakes. It burns a lot of fuel and doesn't get you there any faster. So you see, the battle for your financial future is often won or lost on this battlefield of basis points, these tiny hundredths of a percent. You cannot control if the market goes up or down next year. You cannot control geopolitical events or Federal Reserve policy, but you have absolute 100% control over the fees you are willing to pay. Minimizing costs is the single most powerful and reliable move you can make to maximize your wealth. It's the closest thing to a free lunch in all of finance. Now that you're armed with this crucial knowledge, you can spot the wealth traps from a mile away. You understand the silent killers. But the question remains: how do you find the diamonds in the rough? Where do you actually go to screen for funds with rock-bottom expense ratios, no sales loads, and a strategy that aligns with your goals? In the next part, we're pulling back the curtain on the exact tools and websites the pros use to do just that, turning you from a passive passenger into a savvy captain of your own ship. Alright, let's open up the toolbox. The first and most essential tool, the one that's basically the industry standard, is Morningstar. Think of Morningstar as the encyclopedia, the Kelley Blue Book, the absolute Bible for mutual funds. While they have a premium subscription, the amount of mission-critical information you can get for free is staggering. When you land on their site, you'll use the search bar to type in a fund's name or its ticker symbol, that 5-letter code we talked about. Let's say you're looking at a big, well-known growth fund. The moment you pull up its page, you're hit with a deluge of data. But don't get overwhelmed. We're going to zero in on just a few key areas. First, you'll see the famous Morningstar star rating. It's a simple 1 to 5 star system. It looks great, it's easy to understand, and it's a starting point, but you should treat it with a healthy dose of skepticism. This rating is purely backward-looking. It tells you how a fund has performed in the past, after adjusting for risk and fees, compared to its peers. A 5-star rating means it did great. A 1-star rating means it did poorly. But past performance, as every single financial disclosure will tell you, is no guarantee of future results. A 5-star fund can be a 1-star fund 3 years from now. So glance at it, acknowledge it, but do not make it your primary decision-making factor. Instead, scroll down and look for the numbers that truly matter. Find the expense ratio. We've hammered this point home, but Morningstar lays it out plain as day. You can see the fund's ratio and often compare it directly to the category average. If the fund you're looking at has an expense ratio of 1.2% and the average for large growth funds is 0.8%, that's a massive red flag. You're paying a premium, and you need to ask yourself if the performance justifies it. Next, look for a metric called the turnover rate. This is a crucial number for growth funds that most people ignore. The turnover rate tells you how much of the fund's portfolio is bought and sold each year. A 100% turnover rate means the manager, on average, replaced the entire portfolio within the last year. For growth funds, a higher turnover rate isn't necessarily bad. The manager is actively hunting for the next big thing. But extremely high turnover, say 150% or more, can be a warning sign. It can rack up trading costs inside the fund, which are passed on to you, and it might indicate a lack of a coherent long-term strategy, more like frantic day trading than disciplined investing. Then, click on the Portfolio tab. This is where you get to look under the hood. Morningstar will list the fund's top 10 or 25 holdings. Are these companies you recognize? Are they the kind of innovative, high-growth businesses you expected to see? More importantly, look at the concentration. If the number one holding makes up 12% of the entire fund, you need to know that. Your investment in this diversified mutual fund is now heavily dependent on the fate of one single company. That's a risk you need to be comfortable with. The second tool in our kit is Yahoo Finance. If Morningstar is the deep dive encyclopedia, Yahoo Finance is the quick reference field guide. It's fast, free, and fantastic for direct comparisons. Once you've used a screener to find a couple of funds you like, you can pull them both up on Yahoo Finance. Their charting tool is incredibly intuitive. You can overlay the performance of 2, 3, or even 4 funds on top of each other in an index like the S&P 500. This lets you see visually how they've stacked up over the last year, 5 years, or even since their inception. Did one fund consistently outperform the others? Or did it just have one lucky year? Did it fall harder during a market downturn? This visual comparison can be more revealing than a spreadsheet full of numbers. Yahoo Finance also has a Holdings and Performance tab, similar to Morningstar, but it really shines in its integration with news. You can easily see recent news articles and press releases related to the fund or its top holdings, giving you a real-time pulse on what's happening. Now for our third and arguably most important tool. It's the one most people are terrified of, but it's where the absolute truth lies: the fund's prospectus. Yes, that dense, legal-looking document. Every mutual fund is required by law to have one, and you can find it on the fund company's own website, usually as a PDF link. I know it looks like a cure for insomnia, but you don't need to read all 80 pages. You just need to know where to look. Use Ctrl+F, the search function, to be your guide. First, search for investment objective or principal investment strategies. This is the fund telling you in its own words what it's trying to do. Does it say it invests in large capitalization companies with the potential for above-average earnings growth? Perfect. Does it say something vague or different from what you thought? Red flag. This section is the fund's mission statement. Make sure it aligns with your mission. Next, search for the fee table. This is the holy grail. It's a standardized table that breaks down every single fee, from the management fee to the 12b-1 fees, and culminates in the total annual fund operating expenses. This is the number. This is the truth, straight from the source, no ambiguity. Compare this number to what you saw on Morningstar. It should be identical. Finally, and I cannot stress this enough, search for principal risks. This is the part everyone skips. This is the fund's management team sitting you down and telling you, look, here are all the ways you could lose money with us. They'll talk about market risk, the risk that the whole stock market goes down. They'll talk about growth stock risk, the fact that growth stocks can be more volatile and fall out of favor. They might even mention manager risk, the risk that the person running the fund makes bad decisions. Don't be scared by this section. Be empowered by it. Understanding the risks before you invest is the hallmark of a mature investor. Okay, that's how you analyze individual funds. But how do you find them in the first place? Out of the thousands of funds out there, how do you even begin to build a shortlist? For that, we use our fourth tool, a good brokerage screener. Whether you use Fidelity, Charles Schwab, Vanguard, or any other major brokerage, they will have a powerful mutual fund screening tool. Think of it as a super filter for the entire universe of funds. This is where you put our criteria to work. You'll go to their screener and start checking boxes. First, under asset class, you select stock/equity. Then you can filter by category. You'll see options like large growth, mid-cap growth, or small growth. Let's pick large growth. Instantly, the list of 8,000 funds might shrink to 800. Now we apply our own rules. Find the filter for expense ratio and set the maximum to, say, 0.6%. Poof! Another 300 funds disappear. Find the filter for no load. Check that box. Another 200 funds are gone. Many screeners have a checkbox for no transaction fee, or NTF. This means if you buy the fund through that brokerage, you pay 0 commission. Check it. Now your list of 800 is maybe down to 100. Finally, you can even add a performance filter. You could specify that you only want to see funds that have beaten the S&P 500 over the last 5 years, or funds that are in the top 25% of their category. Suddenly, you've taken an overwhelming ocean of choices and narrowed it down to a manageable pool of maybe 15 or 20 high potential candidates. This is your shortlist. From here, you take these ticker symbols and run them through Morningstar, Yahoo Finance, and their prospectuses to do your deep dive research. You now have the complete process. You know how to filter the entire market down to a handful of promising funds, and you have the tools to dissect each one of them like a pro. You can analyze their costs, their strategies, their risks, and their portfolios. But there's one final piece of the puzzle. Data and numbers can tell you what a fund has done. They can't always tell you why. For that, we need to look beyond the spreadsheet and analyze the most unpredictable variable of all, the human element. The fund manager. Think of a fund manager as the captain of a massive ship. The fund's prospectus is the ship's blueprint, the data is the navigational chart showing where it's been, but the manager is the one at the helm, making real-time decisions in a storm. They decide when to press forward, when to tack, and when to drop anchor. A great captain can navigate treacherous waters and find new routes to prosperity. A poor one can run the most technologically advanced ship aground. For decades, the investing world has been obsessed with the idea of the star manager. The legend, the genius stock picker who seems to have a crystal ball. The most famous, of course, is Peter Lynch. During his 13 years at the helm of Fidelity's Magellan Fund, from 1977 to 1990, he delivered an astounding average annual return of over 29%. He didn't just beat the market. He redefined what was possible for a mutual fund. People didn't just invest in Magellan, they invested in Peter Lynch. He became a household name, a financial celebrity. His success was built on a clear, understandable philosophy. Invest in what you know. He looked for companies with simple business models, strong balance sheets, and a durable competitive advantage. He was the proof that a single brilliant mind could pilot a fund to legendary status. But this highlights the double-edged sword of the star manager system. What happens when the star leaves? When Peter Lynch retired, a massive cloud of uncertainty hung over the Magellan Fund. Could anyone possibly fill his shoes? The fund's performance post-Lynch was, well, it was fine, but it was never the same. It became a cautionary tale about something called key person risk. When you invest in a fund that is so intrinsically tied to one individual, you are betting on that person's continued health, focus, and presence. If they retire, get poached by a competitor, or simply lose their touch, the entire strategy can fall apart. So, the first question you have to ask when evaluating a manager is, am I investing in a person or a process? A fund built around a durable, repeatable process is often more resilient than one built around the gut feelings of a single genius. The process is the institution's intellectual property. It's the system for identifying opportunities, managing risk, and making decisions. It can be taught, refined, and passed down to a successor. A fund with a strong team-based process is like a well-run airline. You don't really care who the specific pilot is on your flight today, because you trust that every pilot has been trained to the same exacting standards, follows the same checklists, and is supported by a massive ground crew and air traffic control system. Conversely, a fund built entirely around a star manager is more like betting on a single brilliant surgeon. She might be the best in the world, but if she's having a bad day, or if her hands aren't as steady as they used to be, the outcome is far less certain. There's no backup. So how do you figure this out? You have to become a bit of a detective. Start with the fund's shareholder letters and manager interviews. Ignore the jargon and the self-congratulatory pats on the back. Look for consistency. Is the manager talking about the same core principles today that they were 5 years ago? Or are they chasing the latest hot trend? A manager who was a deep value investor in 2019, but is suddenly an artificial intelligence expert in 2024, should raise a massive red flag. This is called style drift, and it's a cardinal sin in fund management. It tells you the captain doesn't have a map. They're just following the blinking lights of other ships, hoping they lead somewhere good. A great manager, even when they're losing, can clearly articulate why they are sticking to their strategy. They'll say something like, "Our focus on companies with high free cash flow has caused us to underperform in this momentum-driven market, but we believe this discipline will be rewarded over the long term because of X, Y, and Z." A bad manager will make excuses or worse, change their story to fit the current narrative. The next thing to look for is tenure. How long has the manager or management team been in place? In the world of mutual funds, stability is a virtue. A manager who has been at the helm for 10, 15, or even 20 years has seen it all. They've managed through bull markets, bear markets, flash crashes, and speculative bubbles. They have scar tissue. They've made mistakes and hopefully learned from them. A fund with a revolving door of managers is a sign of internal chaos. You wouldn't want to be on a ship where the captain is replaced every time you hit a bit of rough sea. But here's a pro tip, something most retail investors miss. Look beyond the lead manager. Who is on the team? Are they supported by a deep bench of analysts? Many of the best funds in the world operate on a team-managed basis. There might be a lead portfolio manager, but they work with a team of co-managers and analysts, each specializing in a different sector. This structure provides a diversity of thought and reduces key person risk. The debate and discussion within the team can sand down the rough edges of any single person's biases. The downside: a team can sometimes be slower to act, getting bogged down in consensus building. A single manager can be more nimble and decisive. There's no right or wrong answer here, but you need to understand the structure you're buying into and be comfortable with its inherent trade-offs. Now let's talk about the single most important alignment signal: skin in the game. Does the fund manager eat their own cooking? In other words, do they invest a significant amount of their own money in the very fund they are managing for you? Think about it. If a chef refused to eat the food coming out of his own kitchen, would you want to eat there? Of course not. It's the same with fund managers. When a manager has their own capital on the line, their interests are directly aligned with yours. They feel the pain of a downturn just as acutely as you do. It focuses the mind wonderfully. You can find this information, though it's often buried. It's not on the glossy marketing page. You have to look in a document called the Statement of Additional Information, or SAI. It's the boring, legalistic cousin of the prospectus. But in there, you'll find a table that shows how much each manager has personally invested in the fund, usually broken down into ranges. If you see a big fat zero next to the manager's name, you have to ask yourself why. Maybe they have a legitimate reason, but it's a question that demands an answer. A manager with over $1 million of their own money invested in the fund? That's a powerful statement of belief in their own strategy. Finally, assess the manager's character through their communication, especially during tough times. Anyone can look like a genius in a bull market. The true test of a captain is how they behave in a hurricane. When the fund is down 20%, what does the shareholder letter say? Does the manager take responsibility? Do they clearly explain what went wrong, what they learned, and what their plan is moving forward? Or do they blame the market, the Fed, or bad luck? Humility, transparency, and accountability are not just personality traits. They are critical components of a successful long-term investment process. A manager who is arrogant and defensive in the face of poor performance is likely to double down on bad decisions. So you see, the human element is not a soft, fuzzy, optional part of your analysis. It's the core of it. The numbers tell you the what. The manager tells you the why and the how. They are the strategist, the risk manager, and the ultimate arbiter of where your money goes. Choosing a fund is not just an investment in a collection of stocks. It's an act of trust in the judgment and discipline of the person or team making the decisions. You've now learned how to dissect a fund strategy, how to interpret its performance data, how to analyze its fees and risks, and now how to vet the people in charge. You have all the tools to identify a truly world-class growth fund. But finding the perfect fund is only half the battle. A single instrument, no matter how masterfully crafted, doesn't make an orchestra. The final critical step is understanding how to combine these instruments, how this one great fund fits into your overall financial symphony to create a portfolio that can weather any storm and achieve your most ambitious goals. Because a portfolio with only high-flying growth stocks is like an orchestra with only trumpets. It might be loud and exciting for a moment, but it lacks depth, resilience, and the harmony needed to create something truly beautiful and lasting. You, the investor, are the conductor. It's your job to arrange the different sections, to know when to let the violins soar and when to bring in the steady beat of the drums. So how do you do it? How do you build this financial symphony? The most proven and effective strategy for most people is called core and satellite. Think of it as your sheet music. It's a simple, elegant framework for building a powerful, diversified portfolio. Your core is the foundation of your orchestra. It's the largest section, the one that provides the main melody and structure. This should be a broad, low-cost index fund, something like a total stock market fund or an S&P 500 index fund. This is your bedrock. It gives you exposure to the entire U.S. economy. It's reliable, it's steady, and it will capture the overall growth of the market over time. For many investors, this core might make up 60, 70, or even 80% of their total portfolio. It's the musical theme that everything else is built around. Now for the exciting part, the satellites. These are your specialized instruments, the ones that add flavor, excitement, and the potential for outsized returns. And this is exactly where the growth stock mutual fund we've spent so much time analyzing fits in. It's a satellite. It's your high-powered brass section, designed to hit those incredible high notes of growth. You might allocate 10, 15, or 20% of your portfolio to a fund like this. But you don't stop there. A great conductor uses a variety of instruments. Another satellite might be an international stock fund, giving you exposure to companies and economies outside the United States. Think of this as your woodwind section, adding a global, sophisticated flair to your composition. Another satellite could be a small-cap value fund, focusing on smaller, potentially undervalued companies. That's your quirky, interesting percussion section. And for balance, especially as you get older, a key satellite is a bond fund. Bonds are the steady, rhythmic bassline of your portfolio. They generally move in the opposite direction of stocks, providing stability and calm when the stock market gets turbulent. Let's make this real. Imagine a 30-year-old investor with a long time horizon and a high tolerance for risk. Their symphony might look like this: 70% in a core S&P 500 index fund. Then, for the satellites, 15% in an aggressive growth stock mutual fund, and 15% in an international stock fund. It's simple, diversified, and geared for growth. Now, picture a 55-year-old investor who is planning to retire in the next 10 years. Their risk tolerance is lower. Their symphony needs to be more focused on preserving wealth while still generating some growth. Their composition might look different: 50% in that core S&P 500 fund. But their satellites are focused on stability: 30% in a total bond market fund to reduce volatility, 10% in a dividend-focused fund for income, and just 10% in a growth stock mutual fund for that extra kick. See how it works? The growth fund is a powerful tool, but its role changes depending on the overall piece of music you're trying to create. Your age, your goals, your comfort with risk. These are the factors that determine your unique composition. There is no single right answer, only the right answer for you. But building the perfect portfolio, choosing the right funds, and allocating them perfectly is only half the battle. The greatest challenge you will ever face as an investor isn't picking the right stock or fund. It isn't timing the market. The greatest challenge is conquering the enemy that lives between your own two ears: your own psychology. The market is a relentless test of our emotions. When stocks are soaring and everyone on the news is talking about a new tech boom, the fear of missing out, FOMO, can be overwhelming. It tempts you to abandon your carefully crafted plan, to throw all your money into the hottest trend, to let that trumpet section drown out the entire orchestra. This is how bubbles are formed, and it's how fortunes are lost. Even more powerful is the opposite: fear. When the market inevitably crashes, and it will crash again and again, the panic is visceral. Watching your portfolio value drop by 20 or 30% feels like a punch to the gut. Every instinct in your body will scream at you to sell everything to get out before it goes to zero. This is the moment when the conductor flees the stage, the orchestra descends into chaos, and long-term wealth is destroyed. Selling at the bottom locks in your losses and ensures you miss the eventual recovery. Your core and satellite strategy, your written investment plan, is your anchor in this emotional storm. It is the captain's log on a ship being tossed by a hurricane. When the waves are crashing over the deck and your senses are screaming that you're sinking, you don't rely on your feelings. You rely on your instruments. You trust the plan you made when the skies were clear and your mind was calm. The single most powerful way to enforce this discipline is through automation. Set up automatic contributions from your paycheck to your investment accounts every single week or every 2 weeks. Don't even think about it. This is a strategy called dollar cost averaging. When the market is high, your fixed dollar amount buys fewer shares. When the market is low and on sale, that same dollar amount buys more shares. It forces you to do the exact opposite of what your emotions tell you to do. It forces you to buy low and be cautious when things are high. It turns market volatility, your greatest enemy, into your greatest ally. It is the relentless, disciplined rehearsal that guarantees a flawless performance over decades. Because in the end, that's what this is all about. This entire journey, all 10 parts of this series, from understanding what a mutual fund is to analyzing expense ratios and building a diversified portfolio, it was never really about the numbers on a screen. It was never about charts or tickers or financial jargon. It's about what that money can do for you. It's about freedom. It's about having the option to walk away from a job you hate. It's about funding your kids' education so they can start their lives without a mountain of debt. It's about buying that house with the big backyard you've always dreamed of. It's about the peace of mind that comes from knowing you have a safety net, that an unexpected medical bill or car repair won't derail your entire life. It's about taking that trip to Italy, or starting that business, or retiring 5 years early to spend more time with your grandkids. This is the symphony you are composing. Every dollar you invest is a musical note in the score of your life, and a well-chosen growth stock mutual fund, placed carefully within a thoughtful, disciplined portfolio, can be the crescendo that turns a simple melody into a masterpiece. Over these 10 parts, you have gained the knowledge that separates the successful investor from the speculator. You know how to find a fund, how to vet its manager, how to read its prospectus, and how to understand its costs. You know how to fit it into a broader strategy that aligns with your personal goals. You now know more than 90% of the population about how to build long-term wealth. The knowledge is yours, but knowledge without action is just trivia. The final, most important step is up to you. Your journey as a passive learner is over. Today, your journey as an active conductor begins. So my challenge to you is this. Don't just click away from this video. Take one small concrete step this week. Open that IRA or that brokerage account you've been putting off. Set up an automatic transfer of just $50. Buy your first shares of a core index fund. The amount doesn't matter. The action does. Starting is everything. Thank you for joining me on this incredible journey. It has been a privilege to be your guide. If this series has provided you with value, the best way to support this channel is to subscribe so you don't miss what we have coming next. Because our financial symphony is just getting started.